In this video, as we do every week, we review the 10 main factors that influence silver prices and evaluate what they currently signal. The US, the European Union, and China are still growing. Continued economic growth means ongoing industrial production, infrastructure projects, technology spending, and investment in clean energy. Silver plays a key role in all of these areas. Because it is both an investment asset and an industrial metal, steady global growth supports long-term demand. As long as major economies keep expanding, the broader demand outlook for silver remains solid. Silver inventories in COMEX vaults have fallen from about 430 million ounces to roughly 379 million ounces. That is a significant decline in a short period and points to strong physical withdrawals. Inventories in Shanghai have also been trending lower. Since China is one of the largest physical buyers of silver, falling stock levels may reflect healthy domestic demand. Although there are short-term fluctuations, the overall trend suggests tightening supply rather than expansion. The Fed's balance sheet has increased slightly, rising from around $6.54 trillion to about $6.62 trillion. This indicates that liquidity in the financial system is no longer shrinking and may be expanding modestly. When liquidity improves, commodities and precious metals often benefit. A more supportive monetary environment can make non-interest-bearing assets like silver relatively more attractive. January inflation came in below expectations, with consumer prices rising 0.2% month over month. Lower than expected inflation reduces pressure on the Federal Reserve to raise rates further. It may even create room for rate cuts later on. Lower interest rate expectations generally support precious metals because they reduce the opportunity cost of holding them. The U.S. M2 money supply has continued to rise and now stands near $22.4 trillion. An expanding money supply signals improving liquidity conditions. When liquidity increases, investors often look for ways to protect purchasing power or diversify into alternative assets. Silver can benefit in such an environment. Total U.S. debt has climbed to approximately $38.5 trillion and continues to grow. Rising government debt can raise long-term concerns about fiscal sustainability and currency stability. In response, some investors diversify into tangible assets. Silver may attract demand in this context. Flows into the SLV ETF have been uneven. There have been some strong inflows, but overall participation remains inconsistent. This suggests that investor interest has not yet fully strengthened. Sustained and regular inflows would provide clearer support for higher prices. Central banks continue adding gold to their reserves as part of diversification strategies. This trend reflects ongoing institutional confidence in precious metals. When demand for gold rises at the official level, it often supports sentiment toward the entire precious metals sector, including silver. Open interest in silver futures is close to 200,000 contracts, with a slight recent decline. Large traders still hold meaningful short positions. However, if these short positions begin to decrease more noticeably, that could increase the chance of upward price pressure. Geopolitical tensions, trade competition, high public debt levels, and energy supply risks continue to create uncertainty. During uncertain periods, investors tend to favor assets perceived as safe or defensive. Precious metals often benefit from this shift in sentiment. Overall, 8 of the 10 factors are positive for silver, while 2 are neutral. Importantly, none of the indicators are negative. This suggests that the broader macro and fundamental environment currently supports silver. However, short-term volatility remains possible. If the neutral factors turn positive, the upward potential for silver could become stronger. If you found this analysis helpful, consider liking the video and subscribing to the channel. Your support allows us to continue providing clear and consistent weekly updates. I'll see you in the next review.